Japan is moving to regulate crypto like traditional finance. Ethereum staking just hit 32% of supply. Bitcoin ETFs are breaking internal records at major institutions, and users are now being rewarded in Bitcoin. This isn't random, it's acceleration. This content is for informational and educational purposes only and is not financial advice. Always do your own research before making investment decisions. Welcome to Ledger Pulse, where we break down the signals behind the headlines. If you want to understand what's really moving crypto, the money, the regulation, and the adoption, be sure to subscribe, because you're in the right place. Let's get into it. We start in Japan. The government has recently approved a bill to classify cryptocurrencies as financial instruments. That's a major shift, because it brings crypto under stricter oversight, including insider trading restrictions, mandatory disclosures, and alignment with traditional financial markets. This isn't a ban, it's integration. Japan has historically been ahead in crypto regulation, and moves like this signal something important. Crypto is no longer fringe. It's being absorbed into the financial system. And when regulation increases, so does institutional confidence. Now let's talk about on-chain activity. Decentralized exchange volume has crossed 12.5 trillion for the first time ever. That's not just growth, that's scale. DEXs, decentralized exchanges, are becoming core infrastructure for trading, liquidity, and global access. No intermediaries, no gatekeepers. This is the parallel financial system being built in real time. Now this is where things get very interesting. At Morgan Stanley, the head of digital assets made a notable statement. Their newly launched Bitcoin ETF had the best first trading day of any ETF they've ever released. Let that sink in. Not just strong, not just competitive, the best. And this is coming from one of the largest financial institutions in the world. Morgan Stanley has launched countless ETFs across equities, bonds, and commodities. And yet Bitcoin, a relatively new asset class, outperformed all of them on day one. That tells us something critical. Demand isn't theoretical anymore. It's institutional. And it's immediate. This also reinforces a broader trend. Wall Street isn't cautiously experimenting with crypto anymore. They're seeing overwhelming client demand. And when that happens, they don't resist it. They scale it. Ethereum is quietly hitting a major milestone. Nearly 32% of total supply is staked. Around 38.5 million ETH locked. That's significant, because staking removes supply from circulation, and when supply tightens, price sensitivity increases. At the same time, the Ethereum Foundation is nearing its 70,000 ETH staking target. This shows long-term confidence from within the ecosystem. Now let's break down what's actually driving this market, because not all rallies are created equal. Recent data shows this recent move isn't being driven by short squeezes or forced liquidations or panic buying. Instead, it's being driven by new long positions entering the market. That changes everything, because forced buying is temporary, but intentional positioning, that's conviction. It means capital is choosing exposure, not reacting to volatility. And this kind of structure tends to build stronger support levels, reduce downside fragility, and extend trends over longer periods. In other words, this doesn't look like a spike. It looks like positioning ahead of something bigger. Now let's move into regulation, because this is where the foundation is being set. Scott Bessent is now calling on Congress to pass the Clarity Act. That matters, because for years, the biggest barrier to institutional capital hasn't been interest, it's been uncertainty. And now we're seeing alignment from multiple sides. Brian Armstrong, Cynthia Lummis, and others are pushing for pro-crypto legislation. They're ready for this. This is no longer fragmented messaging. It's coordinated pressure. And if the Clarity Act passes, it could define what assets are securities versus commodities, provide clear compliance pathways, unlock large-scale institutional participation, and finally, get clarity on yield. Because institutions don't move into gray areas. They wait for rules. And those rules are now being written. There's been a lot of fear around stablecoins. Banks have warned that they could disrupt the system, but recent analysis is flipping the narrative. Stablecoins aren't replacing banks. They're enhancing financial infrastructure. Here's why. They increase dollar demand globally. They improve settlement speed, and they expand access to USD liquidity. And now, countries like Canada are formalizing frameworks, one-to-one reserves, regulatory oversight, and guaranteed redemption. This signals a shift in perception, from risk to utility, from disruption to integration. Stablecoins may not weaken the system, they may strengthen it. Now let's talk about where capital is actually moving. Spot Bitcoin ETFs just saw 471 million in a single day. That's not retail, that's institutional flow. And ETF flows matter more than price in the short term because they represent allocation decisions, portfolio integration, and long-term positioning. When institutions allocate, they don't trade in and out. They build exposure over time. And this kind of steady inflow creates structural demand, reduced volatility over time, and a stronger base for future moves. This is how markets mature, not through hype, but through capital flows. Now this might be one of the most important adoption signals in the entire episode. Jack Dorsey's company, Block Inc., is launching a Bitcoin reward system. Users can earn Bitcoin, sats, satoshis, for buying, spending, or self-custodying. This changes behavior. Instead of asking people to invest, it lets them earn. And that's how adoption scales. So let's zoom out. We're seeing institutional demand accelerating, regulation aligning, supply tightening, infrastructure expanding, and capital flowing in. This isn't one narrative, it's convergence. Most people are still reacting to headlines, but the real story is underneath. Crypto isn't emerging anymore, it's integrating. If this continues, institutions deepen exposure, regulation unlocks capital, supply remains constrained, and adoption accelerates. That's the trajectory. That's the signal for today. If you want to stay ahead of the next move, not after it happens, but while it's forming, subscribe to Ledger Pulse. If you found value in this video, hit the like button and drop a comment with your thoughts. I'd love to hear where you stand. And if you'd like to hear more, be sure to check out some of these other videos. I'll see you in the next one.